Well, we made it to episode 15, Justin.
1-5.
I'm Josh Cooper. This guy is Justin Oman. And this is the Maximize Podcast, where we try to bring you value and maximize your knowledge. Yeah, your life in general, but really real estate related. Knowledge is power.
I learned that from Schoolhouse Rock.
Yes, that is there. So today, Justin, we're going to talk about interest rates and how that impacts everyday life in our real estate world, but how that impacts everyone really on their day-to-day life, right?
Yeah, and maybe if they're watching, they may have interest on how that's going to turn out with home values.
Exactly. So that is a big deal, and that's a question we get every single day. And so what's going to happen in the economy? Are we going to have a recession? If we have a recession, how's that going to impact rates? How are those rates going to impact value? Days on market, things like that.
Okay.
What say you?
Well, I'd say, like you were telling me earlier, that some of the articles you read from economists were saying that we're going to hit a recession. Now, recession can sound very, very bad. It basically just means our GDP is going down for consecutive months. It doesn't have to go down drastically, but as you can tell and as you've heard on the news, like it's started to happen based on inflation. But that doesn't mean, and it hasn't meant in the past, again, something that you were reading from the article to me, that interest rates have to continue to go up, which in turn, when a recession hits and the economic values of things go down and interest rates go up, like home prices go down even further. And that doesn't have to happen.
Can I stop you for a second?
Yeah.
Okay. So just so you understand the dynamics of our relationship and our business, our team meetings are me reading to Justin like a bedtime story. And it's really picture perfect, me reading these articles to you and you just grasping that information, being able to share it with our viewers.
Yeah, that's not what happens.
Okay,
Thanks for making it sound like that. Typically, I cuddle up with
Josh
my
was
blankie.
reading to me. Go ahead.
Well, when he has information and he is telling me what he just read, I call that reading to me. He gives me a blanket and a warm cup of milk and just reads me a story.
As bad as my 3-year-old. Ugh. Which I love her. Evelyn, I love you. Sorry, go ahead.
My son Arrow, someday when you see this, I currently have a bruise on my left bicep from where you bit me. Love you, son. Don't know why that happened.
So the challenges, right? So obviously there are things happening in the market that we cannot change.
I can't do anything about it for you.
No, we can't.
But so let's look at it from house prices, home values.
Yeah.
With an interest rate increasing, the purchase price starts to go down based on monthly payments. So when a bank gives you a loan or a mortgage, they didn't 2 years ago decide, I think you can afford a $300,000 house because I think you can pay off $300,000. I think you can afford the monthly payment on what a $300,000 purchase is. Now, if the interest was 10%, your monthly ability on the overall purchase is going to change quite a bit. So your pre-approval for a loan purchase is going to drop. Now, I think what buyers are hoping is going to happen is that if I was approved in 2020 for a $300,000 house, as interest rates go up, that price will go down. And now I'm just going to get that same house at a lower value, and then I'll be able to refinance at some point and make my monthly payment go down. That is not what's happening.
What is happening?
So I actually sat down with someone who is in the real estate game in the Columbus area, and we were talking about this. And I said the best way to picture it is if we kind of roughly remove price points from the picture and we associate it from buyer to home. And if I have buyer A who is looking at this home over here, this home is going down in value, purchase price based on interest rates, but the purchasing power of buyer A is going down to a different, so the buyer is not shifting with the homes. The homes are reducing, but it's not shifting with the buyers in a lot of cases.
Yeah, so you're seeing entry levels of different buyers looking at different types of houses at different price points.
Yeah, so I might have 3 groupings of homes that were tiered at different levels or aesthetics, and those price points shift based on interest rates. But if I was a buyer pre-approved for Group A, I might only be able to purchase on a monthly payment now Group B. Now, Group B is selling maybe below list, where before it was growing above list. So we've reduced the purchase price of those homes, but I have now introduced myself into a new category of homes. And that's the picture of what interest rates can do right now.
And it's really hard for even us as agents to swallow it, but buyers especially. When they're looking at a house in your tier A, and then they're looking at tier B, it's typically a different quality house.
Yeah, and
with different amenities.
And we've seen them lose that, and you can see it in the statistics of the homes coming back on market. They're coming back on market for a few reasons. Some of that is now we're having more inspection periods, at which point RE/MAX Select Associates never stopped requesting inspection periods from our contracts. But two, your interest rate is locked. And if you go past the period where you have it locked and they have to bump you up to the next level interest rate, I have heard and seen buyers losing out on the contract based on financing because at the new higher rate, they had teetered above what they could afford.
Yeah. So help me paint this pictures for our viewers and our listeners. So in January, so what we've seen this calendar year, we have seen unprecedented hikes, relationally speaking, in rates. Mm-hmm. Okay. So I was fortunate enough, we bought our house in January. We have about a 3% rate, which at the time I thought was a little high.
It's not the golden low nugget that you wanted, but it's a good rate.
And so, which our rate before that was 2.85, which awesome, great. But so when we bought the new house, we're at when we bought our house, we're at 3%. Now we have buyers looking at houses with rates of 7 to 8%.
Yeah,
and so you have seen rates in the last 10 months have doubled. An interest rate has doubled. And
depending on the quality of your buyer from the previous year, you've almost tripled some of the closing numbers.
That's true. And it's really hard pill to swallow for a lot of buyers, which I completely understand, because it's dramatically impacted their buying power. So you shared with me the other day at Storytime, the buyer.
That's when Josh lays down on the couch with the warm cup of hot cocoa.
But you shared with me your client when they had purchased versus when they purchased now. You want to share those numbers with me?
Yeah. So I have a buyer that I worked with, and so the rough thing when they got their home purchase, they had enough equity in their previous home to have a down payment and a little bit extra. So that little bit of extra might have been used to be able to buy them points in this market, but instead they got to keep that equity. Now the home they're in now, that they purchased last year.
What's it mean to buy points, just so everyone's clear?
So if you're buying points, you are purchasing down your interest rate. Okay. So the home they're in now has changed in value a little bit. It's slightly higher, but not enough to make up the difference. So they were not teetering on the edge of their affordability, but they were teetering on the edge of their comfort level in purchasing for a monthly payment. They only wanted to be at a certain budget number, and we got them to that budget number. But if they would purchase that same house this year, based on the interest rate they got last year to the interest rate averaged this year on the base, their monthly payment would knock them out of not just comfort level, but out of affordability. It increased almost $2,000 a month based on interest. That's what we mean by going from tier A, if you were looking last year, to now coming back to the market after being dissatisfied with competition and now being a tier B purchaser.
Big difference. And that's real life.
Real life. So if you marry the home, we can get you refinanced in a couple years. I understand the frustration of the competition that we went through the last couple years, but you literally have fallen out of the ability to purchase a certain style or value of home.
So there's a couple schools of thought, right? So one of them is, hey, back then I might have got a 3% rate or whatever it was, but you're dealing with multiple offers. So you were bidding, let's say, $50,000 over.
Yeah. Yep.
So this is cash out of your pocket, $50,000 over.
Which you hopefully had in equity, but you're getting rid of the cash.
So what would be better, buying $50,000 like over purchase or over the asking price with a lower rate, or getting a little bit under the asking price now and using that same 50 grand to maybe buy down the rate.
Yeah, well, it's going to depend on your equity. It's going to depend on buying down your rate. It's going to depend on the house you wanted and if you got it, and then when you get to refinance in the future. So there's a very big picture to go over, and you need a lot of whiteboards to kind of walk through it. But you still have to look at the homes that are available. We have so many purchasers, and I think if you want the homes to drop to where they match up with the new interest rate, I don't think that's going to happen, because I think there's way too much upward pressure from equity firms, which have not stopped buying properties. Your rental market that's going high, they are not stopping to purchase rentals. And so if rates go up to 15% and you can't afford to buy, but the home value is dropping, let's just use an easy number, $100,000 home drops to a $90,000 home, but that $100,000 home could still rent for $1,300. The equity firms aren't backing off, so that price isn't going to go down to $70 if that's what it takes to line up with your monthly budget. It just can't happen. And once those equity firms purchase those homes, they're gone forever. Like, they're not coming back to the market unless they're traded in a portfolio. So they are reducing the inventory in the areas they're shopping. And that will drive up some of the home prices too, along with the upward pressure from them buying for rent.
Yeah.
So if you think home values are going to, if you purchase and you think, so let's look at it this way. If you purchase and you think home values are going to crash based on interest rates, and you're going to lose your economic backbone because the values are going to go down and your equity and all that, and you're just going to be a total loss if you have to move, that's not happening. If you thought you were going to be a victor and watch homes crash and then come in with your little bit of cash on your equity and walk away with a big win by purchasing a $300,000 home for $150,000, you're also dreaming there.
No.
You need to be coached in where you're specifically at with your finances and what you need to be. So you need to find people who care enough to work with you to figure out what your financial picture is, and don't think of us as like the enemy that's trying to figure out your social security number and your passwords and how much money you have in the bank. Like, we're genuinely concerned with the best choice for you. So share as much as you feel comfortable so that we can help you make those decisions.
And any good agent will do that. Any good loan officer will do that as well. Loan officer, especially because they'll look at the finances probably a little more strict than we will.
They get a better picture than we do with finances.
But, a good professional will definitely help anyone walk through that stuff.
Yeah. So the important takeaway, I know this is probably a quick one for us, but I think it's important to provide the value on what you see in the market happening. So one, if you've purchased, don't be concerned. If you got a new job out of state, consult with a realtor on what your rent price could be. Maybe it's not worth trying to sell. Maybe it's worth keeping and having somebody manage it and renting. Or how do you sell it? Like, there's different options before panicking. What if I get a new job and my home value goes down? Two, if you've been looking to buy and you're still looking to buy, there's no shame in moving now. Because if interest rates go down, find a lender also. Lenders are offering a lot of deals right now to help you refinance because they know how the market is. So find one of those and be ready to refinance. But if you get the house you want to be in for 5 years, just get ready to refinance and get it purchased.
I saw a quote the other day, and I'll end it on this. From someone that most people have a ton of respect for is Dave Ramsey.
Yep.
Dave Ramsey was asked when the best time to buy a house was, and he said right now. He said over the next 5 years, when's the best time to buy a house in his opinion? And he said right now.
I can get on board with that. We don't need to go into further discussion on it, but I can understand where he's coming from with that.
Yeah. So
maybe we save that quote for later and then expound upon it for 15 minutes.
Another podcast.
Yeah. It's a chance that could happen.
The Maximize podcast?
Yeah, that'd be a good one to do it on, I think. Yeah. Not the Bedtime Story podcast.
No. Nap time.
Starting up next week, Bedtime Story podcast, brought to you by Josh and the media man, Zach Nicolosi.
Media man himself.
All right, guys. Well, we appreciate you tuning in, and we're going to end this before Zach throws that stress ball back at Josh. I'm Justin. This is Josh, and this has been the Maximize podcast.
We're done. Thanks.